Okay, we look at foreign subsidiary, that is IAS 21, foreign currency translation, IAS 21. Now, when we talk of foreign subsidiary, this is where the parent company may decide to acquire a subsidiary in a foreign land or in a foreign jurisdiction. Therefore, remember, the subsidiary in the foreign land will be reporting in the foreign currency, while the local company, like a Kenyan company, will be reporting in local currency. Therefore, when you want to consolidate, the value of currencies is not the same. You will find that maybe, like today, one USD was trading at 135, I think 135, 134. Therefore, it means that this currency is not the same. The currency is not the same. Therefore, if you want to consolidate, you are required to translate the foreign currency into local reporting currency before you do what? Before you consolidate. That is the only issue in a foreign subsidiary. Therefore, we can introduce and say, sometimes the parent company may acquire shares in the subsidiary. Sometimes the parent company may acquire shares in the subsidiary, but in a foreign land, The foreign subsidiary will be reporting in the foreign currency, the foreign subsidiary will be reporting in the foreign currency, which is its functional currency, while the parent company will be reporting in the local reporting currency. Sometimes the parent company may acquire shares in the subsidiary, but in the foreign land. The foreign subsidiary will be reporting in the foreign currency, which is its functional currency, while the parent company will be reporting in the local reporting currency. The foreign currency needs to be translated in the local reporting currency, needs to be translated in the local reporting currency using the presentation currency method as follows. Using the presentation currency method as follows. Number one, all assets and liabilities are translated all assets and liabilities are translated using the closing rate. Using the closing rate, all assets and liabilities are translated using the closing rate, i.e. exchange rate, exchange rate prevailing, exchange rate prevailing at the balance sheet date, at the balance sheet date. All assets and liabilities are translated using the closing rate. What is the closing rate? The closing rate is the exchange rate prevailing at the balance sheet date, at the balance sheet date. Now, before even we go there, let me ask you a simple question there. And this one, I expect my good friend Ruth to answer me. Now, for example, I say 1 Kenya shillings equals to 10 Uganda shillings. 1 Kenya shillings equals to 10 Uganda shillings. Now, out of that, which one is the strong currency and which one is the weak currency? Ruth, that is your question. If I say 1 Kenya shillings equals to 10 Uganda shillings, which one is the strong currency? Which one is the weak currency there? Which one is the strong currency? Which one is the weak currency? Strong Kenya, weak Uganda. Thank you very much, Ruth. Now, if we say 1 Kenya shillings equals to 10 Uganda shillings, it means that Kenya shilling is strong. Now, let me ask you, if I have 2,000 Uganda shillings, I want to translate into Kenya shillings. What will I do? I have 2,000 Uganda shillings. I want to put it in Kenya shillings. What will I do? Will I divide or will I multiply? I want to translate this amount into Kenya shillings. Will I multiply or will I divide? Of course, I will divide by 10 so that I have 200 Kenya shillings. I divide. Thank you very much, Ruth and Edwin. You divide. Therefore, this is what the concept behind what we are discussing, how to translate. Or like, for example, I say 0.9 Kenya Uganda shillings. Uganda shillings equals to 1 Kenya shillings. I say 0.9 Uganda shillings equals to 1 Kenya shillings. Which one is strong? Which one is weak? I want us to understand this concept clearly. If I say 0.9 Uganda shillings equals to 1 Kenya shillings, which one is strong currency? Which one is weak currency? Talk to Mwalimu kindly. Strong Uganda, thank you. Weak Kenya, thank you very much. Uganda strong. Now, I have 2,000 Uganda shillings. Let me say 2,700 Uganda shillings. I want to change into Kenya shillings. I want to change into Kenya shillings. Do I multiply or do I divide, and how much? Kindly do for me, do for Mwalimu that. I have 2,700 Uganda shillings. I want to translate it into Kenya shillings. What will I do there? What will I do? That is the concept behind what we are discussing kindly. Multiply. Multiply. If I want Kenya shillings here, if I want Kenya shillings, If I want Kenya shillings, multiply. If I want Kenya shillings, do I divide or multiply? Edwin, you say multiply. You say multiply. Ruth, you say divide. The best thing here is that we are going to do what? To divide by 0.9. 0.9. How many Kenya shillings do we have there? How many Kenya shillings do we have? It will be 27 divided by 3,000 Kenya shillings. 3,000 Kenya shillings. 3,000 Kenya shillings. That is what we do on translation. Therefore, we were here. Those who have just joined, we say the foreign currency. I'm just repeating what we wrote here. The foreign currency needs to be translated in the local reporting currency using the presentation currency method as follows. This is now the most important part. Number one, all assets and liabilities are translated using the closing rate, i.e., exchange rate prevailing at the balance sheet date. For example, in a foreign subsidiary, examiner will give you, for example, on 1st January, maybe exchange rate is 4. On 1st June, 1st July, for example, it's 5. That 1st December, maybe it is 6. Average during the year, maybe it is 7, for example. Examiner will give you all those exchange rates. Therefore, we are saying, if I want to translate assets and liabilities in the balance sheet, I'm going to take which exchange rate is prevailing at the balance sheet date. Like in this one, I'm preparing my balance sheet at the 1st December, I use 6. That is what we are saying there. If you are not understanding, I believe you can understand that way. Then we go to number 2. Number 2, income statement items, income statement items, i.e., revenues and expenses. Expenses are translated using the average rate. Income statement items are translated using the average exchange rate. Then number 3, ordinary share capital, pre-acquisition profit, and all the reserves are translated using the historical rate. I.e., exchange rate prevailing when the subsidiary was acquired. Exchange rate prevailing when the subsidiary was acquired. Ordinary share capital in the subsidiary, pre-acquisition profit, and all the reserves. All the reserves include share premium, blah, blah, blah. They are translated using the historical rate. Number 4, we say post-acquisition profit. Post-acquisition profit will be determined, post-acquisition profit will be determined as the balancing figure in the translated balance sheet, Post-acquisition profit will be determined as the balancing figure in the translated what? Balance sheet. What do I mean? For example, this is my profit. This is pre-acquisition profit. This is profit for the year. Let me assume we acquired this company in 2020. I'm consolidating in 2024. When I acquired this company in 2020, there was pre-acquisition profit. In 2024, there is profit for the year. And here we have different profits like in 2021, 2022, 2023. Therefore, that middle profit is what I'm calling post-acquisition profit. Therefore, we shall not have exact exchange rate for this one, translation rate for that one. Therefore, what Madim is saying, post-acquisition profit will be determined as the balancing figure in the translated balance sheet. Very straight like that. I have pre-acquisition. Pre-acquisition, we said we are going to use historical. Historical is the rate that was there when the subsidiary was acquired. Then, profit for the year, we are using average. Income statement items, i.e. revenues and expenses are translated using average rate. But we have this profit, the middle one. We don't have the exact exchange rate there. Therefore, we are going to determine it as the balancing figure in the translated balance sheet. Then we go to number 5, lastly, number 5. Number 5, we say, exchange difference arising will be recognized as a reserve in the balance sheet. Exchange difference arising will be recognized as a reserve in the balance sheet. Now we put a note and say exchange difference is the difference arising when units of one currency. Exchange difference is the difference arising when units of one currency are translated into units of another currency using different exchange rates. Different exchange rates. Exchange difference is the difference arising when units of one currency are translated into units of another currency using different exchange rates. Therefore, remember, when we come to assets, we say we are going to use the closing rate. When we come to the income statement, we say we are going to use average. That is a different rate. When we come to reserves, that is the ordinary share capital, pre-acquisition, all the reserves. We are using historical. Therefore, we are using different exchange rates there. Therefore, what Madim is saying, at the end, you will find that we have an exchange difference, translation difference. That translation difference we are saying, we are going to recognize it as a reserve in the balance sheet. We recognize it as a reserve in the balance sheet. That is what we do when we have that. Now, let's look at the steps used as workings, in our foreign subsidiary. Before we look at our question, let's look at the steps used as workings in a foreign subsidiary. Steps used as workings. Steps used as workings in the foreign subsidiary. Now, if I want to do the foreign subsidiary, where will I start? That is what my name is saying, steps used as workings in the foreign subsidiary. Step number 1, translate the income statement. Translate the income statement. Income statement using average rate. Using average rate, translate the income statement using the average rate. Translate the income statement using the average rate. Step number 2, determine the exchange difference. Determine the exchange difference on goodwill, net assets, and any other item that may require to be translated. Determine the exchange difference on goodwill, net assets, and any other item that may require to be translated. Then number 3, translate the balance sheet. 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 Then lastly, number 4, do consolidation. Consolidation workings as usual. Do consolidation workings as usual. Because after you have translated the income statement, after you have determined the exchange difference on goodwill, or after you have translated the balance sheet, it becomes a normal question. Then you do the consolidation workings as usual. What we were doing as usual. You consolidate as usual because it's no longer a foreign subsidiary question. It's no longer a foreign subsidiary question. Any question up to there, my good friend Florence Accord, any question up to that point? Any question up to that point? Any question up to that point? If there is no question, then we look at the question of April 2022, question 1. You open the question of April 2022, question number 1. April 2022, question number 1. Are we there, my good friends? Are we there? Thank you very much, Ruth. If you are there, thank you very much. Now, let's read this question and see what the examiner wanted. This question says, question number 1, B Limited is a public limited company listed in the Securities Exchange. It has diversified its activities by acquiring S Limited, a company domiciled in foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is in Kenya shillings, while S Limited functional currency is the FR, that is franc. The draft financial statement for the year ended 31st December 2021 are as set out below. We have statement of profit or loss for the year end 31st December 2021. We have the income statement where we have the revenue of P and S, cost of sales, gross profit, distribution costs, administrative expenses, operating profits, investment income, finance cost, profit before tax, income tax expense, profit for the period. Statement of financial position is there, where we have property, plant and equipment, investment in S, current assets, we have inventory, trade receivable, cash and cash equivalent. And then we have total equity there. Ordinary share capital, share premium, retained earnings, then we have total equity. We have non-current liabilities, 10% bond, deferred tax. Current liabilities, we have trade payables, then current tax. Additional information, note 1. On 1st January 2021, B Limited acquired 80% of its of S Limited's 1,000 million FR ordinary shares for cash consideration of FR 550 million. That 550 million becomes the investment, the cost of investment. Number 2, as at the acquisition date, the carrying value of S Limited's net assets was 2.6 million, but the fair value was FR 32 million. The excess in fair value over the carrying value was due to an unrecognized brand with the remaining useful economic life of 5 years as at the date of acquisition. Number 3, the non-controlling interest in S Limited as at the acquisition date was valued at FR 1450 million using the fair value method. Number 4, as at 31st December 2021, it was determined that goodwill arising on acquisition of S Limited was impaired by 10%. Number 5, the following foreign exchange rates are relevant. We have 1st January 2021, FR to Kenya shillings, we have 1 Kenya shillings there. That 1st December 2021, we have 4, then average during the year is 6. Required, determine the exchange difference gain arising on retranslation of the net assets and goodwill on acquisition of the foreign subsidiary. Number 2, we want the consolidated statement of comprehensive income and the consolidated statement of financial position there. Those were 20 marks examiner wanted us to determine. Now, in any question, as in any group question, as the rule of the thumb, you are required to start with the structure. You are required to start with the structure. Therefore, let's begin doing this question. We start with the structure always in a group question. I already explained that. I will not go back there. because I already said that the structure will help you to indicate the dates of consolidation and the dates of acquisition. Then number two, you show the shareholding. Is it a subsidiary? Is it associate or whichever? This question says on a P Limited is a public limited company listed on the Securities Exchange. It has diversified its activities by acquiring S Limited, a company domiciled in foreign country. Both companies prepare their financial statement in accordance with international financial reporting standards. Now, note number one, on 1st January 2021, P Limited acquired 80%. Therefore, structure. My structure there, P Limited acquired 80% S Limited. 80%. Therefore, of course, S Limited becomes what? A subsidiary. S Limited becomes a subsidiary. S Limited becomes a subsidiary. S Limited becomes a subsidiary. Now, if S Limited is a subsidiary, when did we acquire shares in S? On 1st January? January 2021. When am I consolidating the books? On 31st December 2021. Therefore, it means that this subsidiary was held for 12 months. In the income statement, we are not going to prorate revenues because it was there for 12 months. Our proration is 12 over 12. Therefore, that is the structure. The first thing we say is the structure. Then number two, net assets for goodwill. Net assets for goodwill. We come to compute what we call goodwill. And goodwill, you always compute it in foreign currency. Goodwill in foreign currency, so that we translate. You prepare it in foreign currency so that you translate. Listen very carefully to Mwalimu here. You prepare goodwill in the foreign currency so that we translate. Now, how do we prepare goodwill? You take your purchase consideration. Purchase consideration in the foreign currency. Examiner told us in note number one that on 1st January 2021, P Limited acquired 80% of S Limited 1,000 million FR ordinary shares for a cash consideration of 35.50. When you check in the balance sheet, there is 710. We multiply by the rate at acquisition, which is 5. 710 is in Kenya shillings when you check in the balance sheet. Kindly, let's move together. When I say we check in the balance sheet, you can't check in the balance sheet. Investment in S is 710. You translate that 710 into FR, of which you take 710 times or the rate on 1st January when we acquired the subsidiary 2021, which is 5. Of course, you get that one. Then I come to add fair value of NCI. I come to add fair value of NCI in note number 3. The non-controlling interest in S Limited as at the acquisition date was valued at FR 1450 million using fair value method. 1450. Therefore, I get total, which is 0, 0, 0. That is 5,000 FR. 5,000 FR. Then I come to less identifiable net assets. Examiner in note number 2 gave me the identifiable net assets. Examiner in note number 2 said like this: as at the acquisition date, the carrying value of S Limited's net assets were FR 2.6 million, but the fair value was FR 32 million. Therefore, the carrying amount is 26. Fair value is 32. which means we have revaluation. There we have revaluation of 600. Therefore, here I come to less 3,200. 3,200 as my net identifiable net asset there. We less the identifiable net assets at fair value, which is 32. Then we get goodwill. Goodwill, of course, it is goodwill of 1,800 in foreign currency. Goodwill in foreign currency. Goodwill in foreign currency. That is our goodwill in foreign currency. That is what you do. That is our goodwill. But remember, in this question, we have fair value adjustment. Fair value adjustment. Fair value adjustment. Every question we have been doing, if you check very well, we have been having fair value adjustment. Therefore, if you are a very, very good student, like my good student Ruth and the rest, I know you are my very good students, you can now no longer wonder when we say fair value adjustment. Because in every question, of course, we have been looking at the fair value adjustment, the fair value adjustment. Therefore, our fair value adjustment is the carrying amount equals to 2,600. Fair value of the net assets is 32. Therefore, it means there is revaluation. Revaluation of 600. Revaluation of 600. Revaluation of 600. In note number 2, the excess in fair value over the carrying value was due to an unrecognized brand. This is an unrecognized brand. Unrecognized what? Brand. Therefore, we shall recognize it in the balance sheet. The unrecognized brand, we shall recognize it in the balance sheet. And of course, there is depreciation. There is depreciation. Of course, there is depreciation, amortization. Sorry, it's not depreciation. It is amortization. With brands, we amortize. We don't depreciate. Sorry for that. With amortization. Who can give us amortization? Amortization is 600 divided by the useful life. Useful life. Useful life is 5 years. 5 years. Which is 120. Therefore, amortization is 120. I believe when we say amortization, you know how we are going to account for it in the income statement, the amortization for that matter. Therefore, we have the structure, we have the net assets there for goodwill. What we intend to do now, we go to our steps for doing foreign subsidiary. Steps for working on a foreign subsidiary question. We said step number 1, translate the income statement into local reporting currency. Therefore, let's go to step number 1. Let's go to step number 1. Step number 1. Step number 1. Step 1. Step 1. Translate what? Translate the income statement. We translate the income statement into the local reporting currency. How do we translate? We are going to say here, or item, sorry, item. Then we take the FR, then we take the red, then the Kenya. Of course, we are translating into Kenya shillings there. Do it quickly, do it quickly. We want to translate the income statement into local reporting so that it becomes a normal income statement. You say item, FR, red, then Kenya, shillings there. Then we start with our revenue. Our revenue is 10,500. We say that income statement, you translate using what? Average rate. My average rate is 6. My average rate is 6. Therefore, I divide by 6. Then I come to the cost of sales. Cost of sales is 63. I divide by 6. I divide by 6. Then I get the gross profit. Gross profit, which is 42. You divide by 6, of course. I come to less expenses. I come to less expenses. My expenses, number one, is distribution. Distribution is 750. Of course, you divide by what? 6. Admin. Admin. Now, when we come to admin, listen very carefully here. When we come to admin, we have 1350. But I'm going to add there the amortization on admin. We have seen amortization of 120. Amortization is 600 divided by 5, which is 120. I add to admin expense. I add to admin expense. Of course, I get how much? When I add 1470. Of course, 1470, I divide by 6 there. I divide by 6. If there was a depreciation, you add to the cost of sales. If there were depreciation, you add to the cost of sales. If there were amortization, you add to admin, unless otherwise examiner has stated that it is a cost of sale or admin, unless otherwise. Then we come to less finance cost. Finance cost. Finance cost is 150. 150, you divide by 6. Then we less taxation. Taxation is 450. You divide by 6. Then we get profit after tax. Profit after tax. We get profit after tax. Let me get the profit after tax. That is 42. $13.80. 13 what? 13.80. That is our profit after tax. 13.80. Then when I'm translating, let me do it quickly. Translation. $17.50. $10.50. $700. $125. $245. I believe you are working out on your own. $25. $75. And of course, $230. That is my profit, my translated income statement. Therefore, I'm done with the income statement. I'm done with the income statement there. That is how you translate the income statement. Now, our income statement is no longer a foreign. It is now in Kenya shillings. That is how you translate the income statement, very easy. It is now no longer a foreign question, the income statement. It's no longer a foreign question. I believe we are okay there. I believe we are okay there. Any question up to that point? Florence, any question there? I know you never miss asking. That's why I like you very much. You never miss asking. I have not muted anyone, therefore you can just ask. Florence?
Thank you, Mwalimu. I joined you very late, but I'll watch the video later. When I have a question, I'll call you.
Thank you for that. Okay, if there's no question, we go to step number 2. Step 2. Step 2. We go to step 2, determination of exchange difference. Determination of exchange difference on on goodwill, comma, goodwill and net assets, goodwill and net assets. Now let's begin with goodwill. Let's begin with goodwill. Let's begin with goodwill. Let's begin with exchange difference on goodwill. Exchange difference on goodwill. Let's begin with exchange difference on goodwill. Now, how do you determine exchange difference on goodwill? You are going to take your goodwill at start, at acquisition. When you acquired, it was 1800. You divide by the opening exchange difference. Opening exchange difference, which is 5. Therefore, my goodwill at that time at of acquisition, it will be 1800 divided by 5, 360. That is my goodwill at the beginning of the year. Then examiner told me that impairment will come to less, impairment loss, so that we get goodwill at the end. Impairment loss is 1800 times 10%. The examiner told us that impairment is 10%. Impairment is 10%. Therefore, I get 180. 180. Impairment loss we divide by average, which is remember, impairment loss is an expense. We say all income statement expenses and revenues. Therefore, impairment loss we divide by 6, which is average rate. Then I get what? I get 30. Therefore, my goodwill here, it needs to be 330, but my goodwill at the end, goodwill at the end is 1800 minus impairment of 180. I get 1620. I get 1620. Remember, where am I getting 1620? It is 1800 minus the impairment. Therefore, at the end of the year, my goodwill in foreign currency needs to be 1620. I divide by the closing rate. My closing rate is 4. The rate at that first is 4. Therefore, when I compare 16, 20 divided by 4, I'm getting 4 or 5. Therefore, my goodwill at the end is 4 or 5. 4 or 5. Therefore, that means that there is exchange difference. Exchange difference of, we compare with 330, 75. That is exchange difference gain. It is exchange difference gain. Because, why am I saying exchange difference gain? When I take my goodwill at the beginning of the year, I subtract impairment using average. My goodwill needs to be 330. Are we together up to that point? Good friends, are we together up to that point? Yes, we are together up to that point. Then we come to compare with our goodwill in foreign currency here. We divide by the closing rate, our goodwill at the end, which we are getting 4 or 5. Therefore, our goodwill at the end is more than what we expect. Therefore, we have exchange difference gain of 75. This exchange gain, you are going to debit goodwill. You debit goodwill with 75. You credit exchange difference. Exchange difference account with 75. You debit goodwill. That is what you do there, my good friends. Then we come to exchange difference on net assets. On net, exchange difference on net assets. Exchange difference on net assets. Here, what do? We take our net assets at start of the year. At start of the year, which is 32. Net assets for goodwill, which is 32. You divide by 5. 5 is the rate when we acquire this subsidiary. You divide by 5, which is the rate when we acquire this subsidiary. Therefore, I get what? That is 32 divided by 5. I'm getting 640. I'm getting 640. Then I come to add profit for the year. Profit for the year. Now, profit for the year is this profit that we have. If it is not translated, it is 13 what? 80. If it is translated, it is 6 what? It is 230. It is 230. Therefore, my total, if I take my profit and my net assets at the start of the year, net assets at the start of the year, plus the profit for the year, what do I get, my good friends? I get 870. If it is translated, when I take the net assets at the beginning of the year, plus the profit for the year, total comes to 870. Then I come to compare with total net assets, translated translated using closing rate. What is my total net assets? My total net assets is 32 plus 13. Therefore, it is 32 plus 13, 80. I'm getting 45, 80. Then this 45, 80, you divide by closing rate, which is 4. You divide by closing rate, which is 4. Therefore, when I divide by 4, I'm getting 1145. Therefore, when I compare what should be my net assets of 870 and the net assets at the end using the closing rate, I get the exchange difference. Exchange difference. Of course, it's exchange difference gain of 275. Exchange difference gain of 275. How do you get exchange difference on net assets? You take your net assets at the start of the year, you translate using the historical rate, the rate at the start of the year. Then you come to add profit for the year. Remember, profit for the year already we have it in our income statement when it is not translated, when it is translated. Therefore, I'm adding on my net assets, I'm adding this. On my net assets translated, I add profit for the year translated, I get 870. Then I come to compare with this net asset when it's not translated, plus the profit for the year, I get 4580. Then I translate using the closing rate. Closing rate, I get 1145. Then we compare. We were supposed to have net assets of 870, but we have 1145. Then what is the difference? The difference is those 275. This 275, we are going to do what with 275? We are going to debit. You are going to debit. You are going to debit net assets. You debit net assets with 275. You credit exchange difference. Exchange difference with 275. You debit net assets with 275. You credit exchange difference with 275. Then we prepare what we call exchange difference account. We prepare what we call exchange difference account. You are going to prepare what we call exchange difference account. Exchange difference account. We prepare what we call exchange difference account. We prepare what we call exchange difference account. Now, out of this, if we acquired a subsidiary like more than 1 year ago, maybe we acquired this subsidiary 2017, 2018, 2020, okay? Examiner will give us the balance brought down of the exchange difference, but in this one, because we acquired at the beginning of the year, there is no balance brought down. Then on net assets, on goodwill, we say you debit goodwill, you credit exchange difference. Thereby say here goodwill, which is 75. And on net assets, we say you debit net assets, you credit exchange difference. Thereby say here net assets, it is 275. Then you give me total. You give me total. How much is our total? 350. Now, out of that 350, we less NCI share. NCI share. Remember, net assets includes also the NCI. What was our NCI? We acquired 80%, therefore NCI is 20%. Therefore, it will be 20% times 350. 70. NCI share is 70. NCI share is 70. Therefore, how much are we going to take to statement of financial position? Statement, the one we are going to consolidate. We take it to statement of financial position. It will be, when we subtract, we get 280. Therefore, this 280 is what we shall take to our statement, our balance sheet, as our exchange difference. 280. We are going to take it to the balance sheet as our exchange difference under the net assets, where we report ordinary share capital, share premium, retained earnings, we ONCI, then we report exchange difference. Then the one for NCI, we shall give it to NCI. When we determine the net assets of NCI for consolidation, we also give them the exchange difference there. We also give them the exchange difference. Any question up to that point? Any question up to that point? Any question up to that point? If there is no question, then let's have a break of 5 minutes. When we come back, the only thing that is remaining is to do the income statement and the balance sheet. Therefore, if there is no question, let's take some water as we come back for the financial statements. Okay, now this translation, you can also just do it in the balance with the question. When you are doing the question, you can just decide to translate in the question. Therefore, also, we are not going to do the translation of the balance sheet so that we just do it in our question. And you see, without wasting much time to translate, you can just do it in a question. Therefore, let's do the income statement of this question, and you will see how we are going to translate just in a question, in a question. Let's do it. We say B limited, consolidated statement of profit and loss for the year ends 31st December 2021. That 1st December 2021. That 1st December 2021, we have shillings in millions. Our currency is shillings in millions. Then we come to revenue. Revenue, we are taking the revenue of 2145 plus the revenue of 10,500 divided by 6. You can just decide to do it here. You can just decide to do it here as what Mwalimu is saying. You can just try to do it there. But I wanted also to do the working for this because of these profits. Because of these profits, you need to work out this because of these profits. As you see, you saw how we used it. Therefore, in this question, there is no UPS. There is no UPS. Therefore, nothing we are going, there is no intercompany sale of goods. Therefore, nothing we are going to do what? Do less. Therefore, you give me the sales there. Revenue. We less the cost of sales. Cost of sales is 950 plus the one, which is 1050. 1050, I'm taking this one. Then you give me cost of sales. We get the gross profit. Because I already translated, I'm just taking the translated figure there. But if you did not translate, well, if we showed you that, you just do it in our question. It's also possible. Then I come to less expenses. Distribution cost. Which is 150 plus, already we did that, 125. That is 275. Admin expense, administrative. I'm taking 345 for the parent, plus for the subsidiary is 245. Then you give me. Then impairment loss. Impairment loss was 30. That is 180. Impairment loss divided by 6. Impairment loss, we got 30. If you remember in our translation, we got impairment loss 1800 times 10%. Impairment was 1800. Goodwill times 10%. It was 180. This 180 we translate using average, we get 30. That's why Marim is reporting 30 there. Then we get profit from operation. Profit from operation. I believe for you, you will not be putting XX. You will be putting real figures. You will be putting real figures there. Then we come to less finance cost, which is the one for H, 30, plus the one for S, which is 25. I will report for you that 55. I come to add investment income, which is H plus S. It's only in H, 15. Only in H, 15. Then I get profit before tax. I get profit before tax. I get profit before tax. Then I come to less taxation. Taxation is 165 of the parent plus the one for the subsidiary 75. If we have associate, we come to report profit after tax from associate. Add profit after tax from associate. In this question, we don't have it. In this question, we don't have it. My dear friends, in this question, we don't have it. But Marim is just showing you that if you have associate or joint venture, don't forget to report that item. Because we said associate and joint venture, you don't consolidate. You only report one item, that is group share of profit after tax. That's why if I have a negative goodwill, Negative good, if my goodwill was negative. In this question, I don't have it. I'm not complicating the question. I'm just showing you that in other questions, you might get those items. When you get them, if my goodwill was negative, you just put it there. Then we get profit after tax. Profit after tax. Profit after tax. Profit after tax. Then we come to less profit attributable to NCI. We come to less profit attributable to NCI. Now, I showed you how to get profit attributable to NCI, but let me also repeat in this question. Let me just repeat for the purpose of internalizing. Let me just repeat. Let me just repeat profit after tax, because I know when you do it several times, you internalize very well. Therefore, NCI profit equals to NCI percentage times profit after tax in the subsidiary. NCI percentage times profit after tax in the subsidiary. Then we come to get adjusted profit after tax in the SUP is a subsidiary. Here we get profit after tax in the subsidiary. Of course, this was 230. When you check in the previous questions we were doing, profit after tax we were apportioning on time basis. This one we are not apportioning. Somebody may ask, why are we not apportioning? Because this subsidiary was there for the whole year. Because the subsidiary was there for the whole year. Then we come to less UPS. UPS, we said if the subsidiary is the selling company. In this question, we did not have the UPS. We come to less if depreciation under, of which in this question there was no depreciation under. We come to less amortization. In this question there was amortization, but already added, already adjusted. Where did we adjust? When we were translating, remember, when we were translating the administrative expense, we added their amortization of 120. Therefore, already it has been adjusted in the books. For us to get this 230, already we added. Let me repeat. Do you remember when we were translating the income statement of when we are translating the income statement? On administrative, we already added that amortization. Therefore, already we have included, for us to get this to 30, already we have accounted for it. Therefore, we don't account for it again. I come to less impairment loss, where we used fair value method. Therefore, of course, I have impairment of 30. We used fair value method. Of course, we have impairment of 30 because we used fair value method. Then we come to add depreciation of a charge. In this question, we did not have it. We get the adjusted profit after tax, which is 200. Then NCI percentage equals to 200 times 20%, which is 40. Therefore, I come to less 40 there. Then I get what we call profit attributable to, I get profit attributable to parent shareholders. Profit attributable to parent shareholders. Kindly allow me leave your class. I have an emergency. Sorry for that emergency. Florence, sorry for that. You will get the video, I believe, by tomorrow. Sorry for that. Kindly sorry. We are sorry for you that very kindly. Okay, we get profits after that, profit attributable to parent shareholder. Then that is the end of our income statement. And that is the end of our income statement. That is the end of our income statement. I believe this one you will be feeling, you take, you add, you get figures there, up to there. Don't put XX in your book kindly. Don't put XX in your book. Then we go to the balance sheet. Let's go to the balance sheet. Let's go to the balance sheet. Let's do the balance sheet.
Mwalimu unmute.
Edwin, sorry for that. Are you getting it now?
Yes.
Thank you very much. Thank you very much. Thank you very much. Thank you very much. I said that PP, you take 4850 plus the subsidiary we just translate in the question like that. Then goodwill, we take the one that was at the end when we translated in our exchange translation, exchange difference. Then we come to brands. There was fair value adjustment on brands. where we had 600, amortization was 120. You subtract first, then you divide by 4, of which you are going to get 120. That is 485 by 4, you get 120. Then nothing else. I come to current. Current assets. Current assets, I'm having inventory. Inventory, I'm taking 1030 plus 2400 divided by 4, the closing rate. There is no UPS. Is there any UPS? Of course, there is no UPS. But if there were UPS, you subtract, I believe you know that. Then the receivables. Receivables. That is 970 plus the one for the subsidiary 1960. Nothing else. Then cash and cash equivalent. For 10. $540 divided by 4. Then you give me total assets. We are done with our assets. We are done with our assets. Very straight like that. Then we come to capital and reserves. Capital and reserves. Capital and reserves. Ordinary share capital. Parent only. Parent only. Parent only, ordinary share capital, parent only, which is 1500. Share premium. Parent only, which is 500. Retained earnings. That one, I said we do it as our last item. You do it as your last item. Non-controlling interest. We are going to do it non-controlling interest. You don't have to worry. Always we do it as our last item. Then we are going to report the exchange difference. Exchange difference, of which we had 280. When you check in our exchange difference account, we had 280 exchange difference. Exchange difference, we had 280. Exchange difference. In our exchange difference account, we said we give NCI. Out of 350, we give NCI 20%. We remain with what we take to the balance sheet. That is where we report it. Mwalimu said we report it in the balance sheet. Then we come to non-current liabilities. Under non-current liabilities, 10% bond. 820 plus 2640 divided by 4. Assets and liabilities you divide by use closing rate. Then we come to deferred tax. Deferred tax 740 plus the one for the subsidiary 21, 60 divided by 4. Then we come to current. We come to current liabilities. Current liabilities, we have trade payables. Trade payables. Which is 1330 plus 2240 all assets and liabilities closing rate, all assets and liabilities. Then we have tax 520 plus 740 divided by 4. Just like that. Then we are done. We get total equity and liabilities. Total equity and liabilities there. Total equity and liabilities. Total equity and liabilities. But remember, we have not done NCI and retained earnings. We have not done NCI and retained what? Earnings. Therefore, let's work out for the NCI and retained earnings. Let's do the NCI and the retained as usual. Even in an exam, my good friends, Mwalimu is insisting if you are willing to pass. This is what you need to do. Because all some of this just addition. But when we come to the retained earnings, it needs a working. Sometimes you might waste time on it. And it is wrong, but you wasted 15 minutes on it. Therefore, I insist that you do it as your last option. So that even if it is wrong, you did not waste time on it. Because it is sometimes challenging to students. Many have come to me and say, Mwalimu, this thing is very challenging. But if you practice it, it's not challenging. But at some time, examiner may include some items that will make it challenging. Therefore, you can waste time on these two items and it becomes wrong. Remember, we don't mark the balancing figure. We mark the entries. Therefore, make sure that most of your entries are correct, like what Marine is doing. Remember, Marine put there a dash. Even you in an exam, put it there a dash. When you have time, you come and now work it out slowly, when you are sure of. Therefore, let's do the NCI. NCI. Let's do the NCI. Here we say, let's do the NCI. We are going to say fair value of NCI at acquisition. At acquisition, it was 1450. You divide by 5. 1450 is in foreign currency. Therefore, you divide by 5 to put it in Kenya shillings. 5. Therefore, 1450 divided by 5. It is 290. 290. Then we come to add group share of, NCI, share, NCI. Share of post acquisition profit. NCI share of post-acquisition profit, the one we reported that was 200 times 20%, which is 40. Which is 40. Then we add exchange difference. I said exchange difference we add. Exchange difference is the only new item here, exchange difference, which was 70. Then you give me fair value of NCI at the end, which is 290. $400. I come to report here 400. Now I'm reporting this 400 when I'm very relaxed. Sina pressure. Sina pressure. Why? Because I know I have added all this, I have already my marks. Therefore, this one, sina pressure. I know out of 10 marks, I was only waiting to get 2. Now, sina pressure, but if you start working out retained earnings, it will take a lot of your time. And remember, in exam, we need to maximize on time. Utilize time very well. That is our NCI. We usually take our NCI at acquisition. We add NCI share of post-acquisition profit, of which you already calculated this when you are looking for NCI. This was 230. If you remember 230 minus impairment of 30, we get 200. Then we take the NCI share. That is what we did. That is what we did. Already we did this when you are looking for the profit attributable to NCI. Then we come to the last item, which is the consolidated retained earnings. Here we take 100% profit of the parent, 100% profit of the parent, 100% profit of the parent, which is $25.60 from the balance sheet. $25.60. 100% profit of the parent, $25.60 from the balance sheet. Then I add group share of cost, acquisition profit from the subsidiary. From the subsidiary, which is 200 times 80%. 200 times 80%, 160. 160. 160 there. Let me confirm. Which is 160 there. Which is 160 there. Then if there is any other income, we also usually add group share of cost, acquisition profit in the associate or joint venture, of which it's not here, it's not there. It is not there. If there is negative goodwill, if there is negative goodwill, But in this case, we don't have it. In this case, we don't have it. Therefore, my total here is 27, 20. 27, 20. That is what I'm coming to report here. 27, 20, nothing else. 27, 20. Then I'm done with the balance sheet. I'm done with the balance sheet. Why do I insist that this item retained earnings you do it at the last item? Because sometimes it's very challenging, my brothers and sisters. Sometimes it's very challenging. But at some point, it's very straight. Like this one, you can see we are just taking profit of the parent. We add group share of post-acquisition profit, of which we got 200 times 80%. We are done like that. We are done. Any question up to that point? I hope our balance sheet will balance. I hope our balance sheet will balance. I'm hoping so. Does it mean profit from attributable to parent shareholding has no impact to the retained earnings taken to balance sheet? Does it mean profit attributable to parent shareholding has no impact? Edwin, that profit, remember we just did it up to, if you want, you continue, you get the same thing here. If you so wish, you can continue and get the same thing here, the same thing. But remember, we did not do the statement of changes in equity where you take, if you want, you can continue. Remember, you take profit attributable to parent, profit attributable to parent, of which it was how much, Edwin? It was how much? Because you asked this one. When in your income statement, it was how much? Edwin, it was how much? 715, thank you. 715. Then you come to add retained earnings brought forward. Retained earnings brought forward from the parent. Retained earnings brought forward from the parent. I will go to the balance sheet. Of course, in the balance sheet, I have 25. I have 25 what? I have 2560 minus profit for the year, which is 555 minus profit for the year, which is 55. I get 20.05. Then I add 715. I get 27.20. Therefore, remember, examiner mostly will mark the income statement up to profit after tax. Therefore, this one is just addition. If you want to continue, get that. It's just your addition. But examiner mostly will have what you marks up to profit for the year. Profit for the year. But this one we have added the retained earnings brought forward. Where am I getting retained earnings brought forward? Total profit in the balance sheet is 2560. But this one is total. Therefore, I subtract profit for the year because it's already consolidated there. It's already included there. When we were consolidating, it's included there. Thereby, subtract 55. Then whatever I get, I add to that. Then I get the profit at the end. But sometimes it's very complicated because if you acquired a subsidiary many years ago, listen, Edwin, if, for example, sometimes you acquired a subsidiary many years ago, then also you need to add retained earnings, post-acquisition retained earnings, post-acquisition retained earnings in the subsidiary. In the subsidiary, which of course many students forget. Many students forget. That's why Mwalimu wants to make things easy. Because if I start including those items, you will find group accounts very complicated, of which it is not good. Things must be easy. Things must be easy that way. Therefore, that is the end of our group accounts. Tomorrow, God willing, if we shall meet, we shall be looking at group cash flows. Tomorrow, if you meet, we shall be looking at group cash flows. That is, if we meet tomorrow, we look at group cash flows. Therefore, that is the end of our group accounts, group discussion. What is remaining is group cash flows. Then we are completely done with group. Therefore, you need to start revising very serious because time is not on our side. We are only remaining with 1 month, which is not good. Although we are also remaining with few topics, EPS, segment, insurance, banking, then we are done. Therefore, you need also to motivate mwalimu by revising a lot. Thank you very much for your time. Let's meet tomorrow, God willing. Bye-bye.